Mutual funds versus index funds versus ETF. What are all these three things? What are the similarities between them? And what are the differences? And how to identify what you're buying on the stock market, whether it is index fund or ETF or mutual fund. In today's video, we'll talk about that. So the first thing which I realized after I've been researching the information, and which is a key idea of this video, is that all these three things in the beginning were mutual funds, then index funds, and then ETF, are one single idea that has been developing over a certain period of time until modern times. And the core idea of that value has been the same, but just it has been developing and growing as the technologies and the stock market had been developing. But the core idea is the same of all these three things. So in the beginning, there were mutual funds. In the 1890s, they were created, and basically what is mutual fund is a pool of money that a group of investors bring together and give it to a fund manager. And that fund manager, a real person, later will decide which stocks and securities to buy, and then the profit of that index will be distributed equally among all the shareholders of that fund. And the good things about this is that with a single-time investment, you are buying basically a bunch of different stocks, and it is quite convenient that you pay one time and then you buy a series of stocks. And then the second thing is that with that bunch of stocks comes the diversification, so that all your securities are diversified between different companies and between different sectors. But then the downside of such index funds were that they were actively managed by a fund manager, a real person who was making decisions which securities to buy and making transactions himself. And which is a downside, because especially in the long term, active management usually gives lower returns than just passive following to some index. And the second thing, which comes from the first, that this fund manager takes a big commission for things that he is doing, for picking the stocks and making transactions, which is sometimes can be 1 to 2%. And this may seem as a small amount, 2%, but you have to understand that this amount is paid every year depending on your amount of your investment. And this is applied to all of your investments, so that if you pay $10,000, then 2% of that will be $200. And even if the returns are negative, you still have to pay minus 2% from your initial investment, which is quite bad. Later, when the investors got tired of the idea of mutual funds and that they have paid big commissions to the fund manager to keep the fund working, they came up with an idea. So in the 1970s, Jack Bogle, who is currently a CEO and a founder of Vanguard Group, he came up with idea of index funds. So what are the similarities between the index fund and mutual fund? That it is still quite convenient that just for a single time investment, you are the owner of multiple stocks, and these stocks are diversified, so it's convenience and it's diversification. This is still preserved here in the index funds. But what has changed here, that now this index fund is not managed anymore by a physical person, by a fund manager, and now it's just fixed to a certain index. So it's managed passively, and there is no need to physically make decisions which stocks to buy, when to buy, and any of that analytical decisions. And therefore, after that, there are much lower commissions or expense ratios for such index funds. They can be around 0.03%, which is much lower and gives higher returns, especially in the long term. And index funds are sometimes called index mutual funds, which is quite self-explanatory and giving a clue that it's just a mutual fund which is following a certain index. And then, after index funds were created, after 15 years or something like that, were created ETFs, or exchange-traded funds. So, first we will talk about similarities between index fund and exchange-traded fund. It is still convenient that just for a single time payment, you are becoming the owner of a pack of different stocks. And this is still diversification, because that stocks are well diversified among companies and among different sectors. And the idea of following the certain index and passive management is still preserved here. So this is passively managed fund. And the commissions or expense ratio is also quite low here in the ETFs. So these four things are still preserved here: the convenience, diversification, passive management, and low expense ratio. But then, what are the differences? And the core difference between the index fund and exchange-traded fund, that exchange-traded fund is quite self-explanatory. It can be traded on the stock market as a usual share. Now, it rather looks like a company with its own stocks outstanding on the stock market, which can be freely traded in unlimited quantities during when the stock market is open and with limited quantities of that shares. And the idea of fund is gone now, because now in the exchange traded fund, you are not giving your money to the fund and then fund is buying some shares. You're directly buying shares yourself. And the main difference between ETF and index fund, that the shares may be traded in unlimited quantities during a trading day, which is not possible in index funds. In index funds, you can buy certain shares only once per day, per trading day, in the end of the day, and for a set price, which is not that convenient. And this is basically the main difference, and that is why sometimes people confuse ETFs and index funds, and they call ETFs like index funds, but basically there are small minor differences, like the one I've just told you, that it may be traded in unlimited quantities, and the other difference between ETF and index fund is that ETF is more accessible for people. Literally, the price for one share is much lower in the ETF compared to the index fund, and so that everyone can become investor and buy shares in the index fund. And moreover, some brokers, they even allow investors to buy a fractional shares of that index fund. Means it became a lot easier and convenient and widespread to buy some shares of the ETF instead of index fund. And the third difference between index funds and ETFs, that ETFs are more tax friendly. So you're paying capital gain tax on the ETF just as you would pay a tax for a regular shares. So when you're buying a certain share and then you sell it for a different price, and then the difference, that is exactly the difference from which you will pay a capital gain tax. And the mutual fund, the situation is different. Tax is distributed between all the investors holding securities in that index fund, which technically means that you just holding your securities in the index fund may have some taxes addressed to you without you even doing any transactions. It means that essentially nowadays most of the funds that you will buy on the stock markets are ETFs. Even sometimes people call them index funds. Essentially means that they just don't know the difference and they confuse them, or just an old habit to call ETFs and index funds. And most of the things that you will encounter on the stock market is just ETFs. I've seen that, for example, Vanguard is suggesting its clients to invest either in the ETF or in the mutual fund, which is quite doubtful, and I don't know who is gonna do that. And the difference between actually index fund and mutual fund is written on their page. And you can read that too, their explanation of difference between mutual fund and ETF. Essentially, the technologies and the stock markets have developed in today's world so much, and ETF today is the same thing which were the mutual funds before and then index funds later, and ETFs are completely easy to use, can be freely traded, convenient, accessible to everyone, well diversified, and actually honestly I don't know what thing the humanity can create even better than the ETFs, because ETF is a pure idea of perfection in investing. So I hope I made it clear the difference between mutual funds, index funds and ETFs, and as I told you before in the beginning of this video, this is basically the same idea that has been growing, improving and developing over a period of time, making it more widespread to the people, making it more convenient and tax friendly, and therefore nowadays most of the people can freely invest in ETF and become the investor of the biggest companies in the world. And this is a complete miracle in today's world. So if you have any questions, please leave them below in the comments. I will gladly see them there, and cheers!